For those who missed the morning, I'm Max Crawford. I'm the content marketing manager at StartEngine. Howard, by now, I'm sure you know. So we're going to do a little chat about creating liquidity in secondary markets for investors. So I kind of want to start simple. Howard, what is liquidity for investors? What are we even talking about here?
So if those who are familiar with the stock market, a company goes public, you can go on the NASDAQ, on the New York Stock Exchange, and investors who invested in the company originally or in the IPO are what we call primary investors. They bought the shares directly from the company. So now they have those shares directly from the company, and what happens next? Well, if they want to sell them, they go on a public traded marketplace like the NASDAQ. So they go to the broker, they give their shares. If there's no restrictions on the shares, they're able to trade them, and then they can get cash. Takes 2 days after the trade is being completed. That's the typical liquidity. And so people call liquidity events when a company goes public. That's a liquidity event. When a company is sold is a liquidity event. As I presented this morning, the majority of companies in the United States do not go public. I mean, it's 0.0001%. And most of them either get sold on the public markets to another company in order for the investors to cash out.
So when we're talking about these liquidity events, apart from these sort of acquisitions that you're mentioning, going an IPO, it's only taking it, these companies are now public, right? So what does this mean for private companies? Because that's really what we're starting to talk about here.
So absolutely. So the big innovation was the Jobs Act, because again, we're here all together in this room because of the Jobs Act. That was voted in April 2012. The innovation in the Jobs Act, it says that if you do a regulation crowdfunding offering, the investors who invest in your company and receive shares or securities from your company, they're locked for 1 year. That means that for 1 year, they're not able to trade those shares to other consumers out there. It doesn't say how you would trade them after 1 year, but it says you can't trade them for 1 year. The other innovation was Regulation A+, which is the $50 million rule, where you can raise $50 million. That rule says that if you buy shares in the company, you can trade them immediately. There's no lockup period where you have to wait. So this is great. It doesn't say how you can trade them. It just says you can trade them. So the Jobs Act has an incredible, beautiful written rule that will allow trading to happen. However, until now, the only events that we've seen happen with trading is when a company goes on to the over-the-counter market, OTC. There's an exchange called the OTC markets, and they're able to go on there. They have to, it's complicated. They have to become a quarterly reporting company. They have to find market makers. These are companies that will offer to buy the shares and sell the shares as an intermediate on the marketplace. They have to find 2 market makers. They have to have a certain minimal amount of money in their asset on their balance sheet. Just keep going on the list. It just gets harder. So for Regulation A+, typically, you have not seen much going on. There's been maybe half a dozen companies go on those OTC marketplaces or the NASDAQ national markets, which is also like over-the-counter. And then for regulation crowdfunding, absolutely nothing, dead silence.
So before we kind of dive too deep into the reads here, I kind of want to take a step back. So Don touched on this in her presentation. To me, liquidity makes a lot of sense in the value add for the investor. She touched on how venture capitalists and angel investors, if you put your money into a startup, it's locked up anywhere between, 8 to 10 years. Where now if you're saying I have liquidity in this investment, I can sell my shares in a few years. That sounds great. What is the value add for the company?
Well, this is where it becomes really interesting. If you can articulate a path to liquidity to your investors, saying, look, you can invest in my company and by date X or milestone X will offer the shares on a marketplace, you're going to have more shareholders. This is going to attract a lot more people to invest, because the number one, I would say, question we get from investors is what about liquidity?
And so I want to transition a little bit to, what we're working on at StartEngine, which is sort of how these secondary markets function, where investors are trading. You've mentioned OTC markets as well as, national stock exchanges. If we're talking about creating liquidity for, our customers, where is that liquidity occurring and sort of how does that function?
So I can't speak for the entire marketplace, although I study it constantly. However, the ambition we have at StartEngine is beyond just offering our customers a platform that allows them to raise capital from investors. We want to enhance that offering for those investors. We want to help entrepreneurs get a better outcome, get more investors. So you could argue, make the platform easier to use. Yes, that can get you more investors. User interface, better mobile interface, great. But really, is that enough? So in order to, we feel, to get to the next level where we take this crowdfunding, equity crowdfunding business to a 10x where we are today, we believe it's access to liquidity. Allowing these investors to purchase securities, a year later they can trade them, or the next day, depending on what's going on, if it's a regulation crowdfunding versus regulation A+. That is, we believe, critical. So today, you can't really see a solution. So we've announced last year that when we're registered as a broker-dealer, we've applied for that registration over a year ago. When we become registered, and it usually takes about a year, we are going to launch StartEngine Secondary. And StartEngine Secondary is what it says. It's a secondary marketplace for companies, shares. So that means that a company can go and raise $1 million with regulation crowdfunding, and they may get, let's say, 1,000 investors, and then they go to regulation A+, and they raise $5 million from 3,000 investors. Now they have 4,000 investors. That's a real sizable group of investors, and we can offer with StartEngine Secondary an opportunity to let those 4,000 people trade. The ones who invested under regulation crowdfunding will have 1 year lockup. The ones who raised under regulation A+ will be able to trade as soon as the company's on the marketplace. And we haven't defined the rules yet for our marketplace. We haven't said, okay, here's what you need to look like. But we're not going to create those barriers that you see in Wall Street. That is not our objective. Our objective is to create a marketplace that is accessible to entrepreneurs and CEOs of companies so that they can offer to their investors a path to liquidity.
So touching on barriers, I know this is something that came up in the breakout tracks today about, sort of the ongoing requirements after you complete regulation crowdfunding or a regulation A+ campaign. If and when this sort of liquidity exists for companies, what are the kind of requirements? Does this change anything for them from a regulatory compliance standpoint? Is it more work?
Well, it turns out it doesn't make any impact whatsoever on the requirements of a company, the fact that those shares are now being traded on a secondary marketplace. There's absolutely no change on the requirements whatsoever.
It's good to know. I actually didn't know that.
The one thing it's important to point, so the Jobs Act had a huge innovation in the sense that you're able to raise money from the general public. In the past, you would have to register your offering in every state. So let's say you want to sell to people who live in Texas. You would have to go to Texas, the state administrator, and say, I want to sell shares in Texas. And you would, present your offering, negotiate your offering, sign it. Then you would go to the next. There's a famous story where Apple was trying to go public. They were going public. And the state of Massachusetts decided that that was too risky. So Apple was not available to those residents. Well, we know the story. The end of the story is pretty good for Apple. However, it demonstrates how hard it was, how difficult, and that's gone. So what we call the blue sky laws, which is state by state regulation, are preempted with regulation crowdfunding and regulation A+. Wonderful. However, that's for selling shares. Now, when you trade shares between shareholders, those blue sky laws apply. okay? So technically, a company would have to go now to every single state to say, I want to let my investors sell, right? Well, we have ways to go around it. These are called exemptions. And typically, what you will find, and we're going to produce a 50-state report and, explain to all of you how it works, but in a nutshell is this. There's an exemption to registration if you don't solicit investors. So that means that if I want to sell my 500 shares and I put them on the marketplace at StartEngine on secondary, but I don't solicit anyone, I'm not recommending it to anybody, I don't have a broker on the other side who's saying, hey, you should invest, that's a solicitation, that's an advice. If you don't offer that, you can be exempt in most states, not every state, again, we're trying, I'm being general, you can avoid it. And that is a huge innovation because in the past, the way you sold shares, and everybody criticizes me all the time. I always get critics on what we do. They say, Howard, you do not understand what you're doing. I said, okay. They said, look, sell shares, securities, they're not purchased, they're sold. So I don't know if you can see the difference. Sold means someone is banging your phone telling you to buy these things. Here, this is great, you're gonna make a ton of money. That's sold. Purchase is you wake up in the morning, you read an article, and you're like, you know what? I want to invest in that company. And you go to your broker and you say, I want to buy XYZ. And your broker is like, really? Yeah. That's basically purchased. That's not sold, right? So we're changing the model. Our StartEngine secondary is not for people who want to be sold shares. It's for people who are interested in purchasing. That means they're self-directed. They're doing it on their own desire, will, and their own decision. And that's a huge, humongous difference from the past, from how the whole broker-dealer marketplace exists today.
So I want to circle back to exemptions because I think 12G is also sort of important about how this changes the game. And if you want to elaborate a little bit about what 12G is and how StartEngine and what we're trying to build is exempt from that.
So Rule 12G is another rule. Like, let's make things harder for the entrepreneur. So if you have more than 2,000 investors in your company and your cap table outside of your founders, if you have more than 2,000, you need to become a reporting company. What does that really mean, reporting company? That's basically going public without being public. You have to make quarterly statements, annual audits, which is not required for regulation crowdfunding. You have to maybe subject your company to rules like Sarbanes-Oxley. Your costs have gone way up. Basically, the answer to this is once you reach the 2,000 shareholder mark, your costs go through the roof in terms of legal, accounting, and then you have effort inside of your company. It's just a mess. And for what? So, great news. Regulation A+, regulation crowdfunding, there's an exemption. So if you use what we called a transfer agent that is registered with the SEC, like we own one called Secure, if you use that to track all your investors, you're exempt from this 2,000 shareholder rule. Now there's some details. You can't have more than $75 million of float, but again, it gets to a point where you're a pretty large company, frankly. But it's great news that we found through, studying the rules with our attorneys, that exemption. And so we created StartEngine Secure as a way to offer to our companies the ability to have 10,000 shareholders.
So equity crowdfunding has been around, for several years. It's growing bigger every year, but there's certainly ways that everyone wishes it would be improved. For example, there's been talk about the Jobs Act 3.0, which would increase the $1 million limit on regulation crowdfunding and increase that to $5 million. So my question is, to date, we haven't really seen much in the nature of liquidity yet. Do you see that as a regulatory issue where the laws aren't quite there? Is it just because the market's too young? Why do you think we haven't seen much yet?
The main reason I think that we haven't seen liquidity in our marketplace is we're really too small, frankly. The Wall Street players cannot afford, they can't afford to take a regulation crowdfunding group of shareholders and trade. It's just they can't afford it. You know, the machinery of Wall Street has been designed to work on NASDAQ, New York Stock Exchange, those large national marketplaces. They have the plumbing already created. And they have their lawyers, and they have tons of lawyers, by the way. They have the lawyers who are familiar with how those shares have been issued. They understand all of this. And you bring regulation crowdfunding, regulation A+, and they look at you like you're an alien. It's just, you're really in a different planet. I'm used to that because I came from the video game world where we created our own games with our own rules, with our own liquidity marketplace. We can trade your own weapons, whatever. So I see this as, wow, that's not so complicated. Let's create our own marketplace. Now, in most cases, your broker-dealer, their ambition is not to create a marketplace. Their ambition is to sell shares and securities. But because we're not the traditional financial, broker-dealer or financial firm, we're less than traditional, we're completely different. We thought, hey, it makes sense to do both, to be helping the companies raise capital, issue their shares, and then we let it trade. All inside of the StartEngine ecosystem. The registered transfer agent concept, StartEngine Secure, happened because we needed it in order to provide the plumbing in one place.
So I'm kind of curious what your thoughts are on sort of how liquidity affects companies. So it helps them raise more capital, great. Investors can trade, it's great for them. How does that affect the company's growth strategy? Does it impact future rounds of funding, for example, exit strategies? How does that play into a long-term plan for a company?
That's a great question because you could argue that once your shares are trading, there's risk because if they trade down, how are you going to raise money? That's going to be hard because everyone's going to say, well, last time I invested, I lost money. If they trade way, way, way up, how do you sell shares for less because people are trading it for a higher marketplace? My opinion is this. First, you're not going to put your shares on StartEngine secondary until you've raised enough money to operate your business, but you're always going to need more capital down the road. And then you do what we call a secondary offering. And that's basically, some people call it a shelf offering. So using Regulation A+, you literally could sell into the marketplace. So you become the seller in the marketplace the same way as someone else is selling shares. So it's assuming you have enough liquidity, being a seller into the same marketplace will fluctuate the price. So the shares, but you're limited by the rules of the SEC to maybe, I think it was 30% or 40% of the total float. So you can't take over the market. So it's pretty well documented. What I'm talking about is used by companies who have hundreds of millions of dollars of market cap. But we are thinking, why limit it to only the big companies? Let smaller companies do the same thing. And we've studied the rules. And so far, there's nothing that would preclude this from happening. So we're studying this. We're looking at it. We'll publish information about it. It's certainly after we've launched our secondary marketplace.
And switching to another angle of liquidity for a minute and getting into crypto just briefly. It's something that you've written a lot about in the past year. Certainly the ICO craze and the trading of tokens show that there's a big market demand for trading. What role, if any, do you see blockchain playing in the secondary markets for securities?
Well, as a lot of people have heard, the ICO market was over $10 billion of money raised for companies. It was an insane, crazy time that started very big and then crashed because the SEC came in and did not want this to be a risk to the American public. So they put a big, stop to it. And so you can see a lot of exchanges trading these utility tokens all over the place, which is a great proof that when you provide liquidity, people like to invest. It's a proof of concept. However, it's not a marketplace that is legal for securities. So what does it really mean, the blockchain? Well, our view is this. We created a technology called ERC 1450 based on Ethereum. We also call it Secure. That's the name of, Ledger, LDGR. That's what we call it. And what it is really simple. It allows the shares to be issued as tokens, security tokens, but the investors don't get a private key. So for those who know what crypto is, typically you have a public address that everybody can see, and then you have a private key, is your password. And your password, if you lose your password, you lose your money, you lose your Bitcoin, you lose your Ethereum. And that is pretty harsh. So imagine you want to go home tomorrow, you're on a trip, and you lost your key for your house, and you can't go back to your house, and you're done. That's not how we work here. You know, you can't lose your house, you can't lose securities, right? So what we've invented was a way to have those securities in a token, but you don't have the key. No one has the key. We have the key. We're the only one who has the key. Everybody else has no key, and no one can lose them. But the big opportunity here is the blockchain has an innovation that not a lot of people are talking about, which is transparency. The blockchain will let you know who owns what, who traded to whom. Now, it's all addresses, you know, these are not names of people with their own home address, it's the address on the blockchain. But it gives you a sense of what this company is doing. What does it look like? How many people own the shares? How many people have been trading it? And I think that's an innovation since the ticker tape was invented. The ticker tape was a great innovation for finance because now people could see what the numbers look like for shares really quickly, right? As the trade happened, there was a ticker tape. It showed you the trade, right? And now we can do the same thing with the blockchain in a secure, trustworthy way, show people who owns what in a company and who's traded what in real time. And that, to me, is why we invented Ledger ERC 1450.
Very cool. I don't want to hog the mic. I want to open it up to Q&A with the audience at this time, if anyone has any questions on the topic.
Very interesting talk. How, if you release shares into the secondary market and you want to go IPO onto one of the national markets, how do you pull back shares from secondary and then put them on the larger market?
Well, this is a great question. It turns out it's pretty easy to do. And here's why. I don't know if you know, but on the NASDAQ today, if you're on the NASDAQ, there are other markets you can trade Apple shares. And these are markets, they call them dark pools. These are alternative trading systems like the one we're building. And you can trade Apple after hours. You can trade them in big blocks outside of the marketplace. They get reported the same way, though. So in this question is a great one. You go to the NASDAQ and you sign an agreement to list on the NASDAQ as a company. And basically, you're creating a marketplace, right? You can tell the shareholders that now that you have listed on NASDAQ, you can reissue the shares with the QSIP, the unique ID, CUSIP, QSIP ID, and now their shares that they have are able to be traded on the NASDAQ and put into a broker-dealer. So there is a path that's very clear for a company to go from, let's say, StartEngine secondary, which is private markets, you know, private companies, to the NASDAQ or the New York Stock Exchange when the time is right. It works. We've planned it in the way we've created the system.
In secondary market for blockchain, is there a collateral-backed trading platform that, say, I can buy and then use that as collateral backing for a venture?
That, that is not something we thought of. That's introducing a whole new notion of collateralized assets and lending against it, and that's something, frankly, that could happen with a third party, but that is not something that we've contemplated. That's not on our roadmap at this point.
Hey, how's it going? Well, first, thank you. I spent a lot of time in my childhood playing all of your video games, so thank you for that. But I have a question just about kind of like the STO. So being a hardware company and kind of following Don's journey, and how she went through the coin offering and everything. It became something that's really interesting to me, especially because we're going into emerging markets where they're more cash-based, markets that are transferring into this digital, money field. And with the mobile wallets, like I watch the mobile wallets in China like really explode, and through WeChat Pay and everything like that. So what are like the pros and cons versus doing the common preferred stock, offering versus doing the STO that you would say?
Well, it turns out that issuing common shares or issuing an STO, which is a security token, is the exact same thing. The only difference is the representation. It is legally identical. There's no difference whatsoever. But the representation, so the best way to explain it is, I don't know if you remember in the old days, you would buy stocks and they would send you a stock certificate. So remember the railroad stock certificates, you see them in websites, they're beautiful, with the name of the company, signed by the secretary of the company. That was your shares. And if it burned, let's say your house burned, you didn't lose your shares. Why? Because you contact the company and say, hey, look, my stock certificate burned. So you go to a notary, you do a sworn affidavit, you sign it, you send it to the company, and then they send you another document. It's the same shares, basically. Pretty cool, isn't it? And so from a legal perspective, it's the same thing. So the representation, whether it's a old-fashioned stock certificate or it's a token, is identical. There's absolutely no difference. Now, when you do marketing, you market your raise, you can call it an STO, you can call it a stock offering, whatever. It's really more of a lingo presentation. It really has nothing to do with the underlying security, which is important because in the end of the day, this is highly regulated by the Securities Exchange Commission. They're really interested in protecting the investor. The last thing they want to do is for you to give them shares that they lose the key and then you have no way of getting it back and everybody's getting really upset, and that's not going to happen.
Millennials and using tools like Robinhood, will that secondary market be available to trade in that environment? I've heard you talk about broker-dealer. There's the millennials that are well educated, make their own decisions and follow the market. Is there an open platform where this can be traded, or do we have to trade through your platform?
So unfortunately, at the beginning when we launched StartEngine Secondary, it is on our platform exclusively. Now, the financial industry is designed so that those closed systems, like us, we're a closed system, can open up with broker-dealers. That's what they do. The broker-dealers are like kind of the rim around the whole thing, and they provide the services to bring in money, verify that the money is being purchased for shares, and then they hold the shares on behalf of the customers. Robinhood does that. They do a great job with this. One day, it's possible that I get a call from Robinhood and says, hey, you know what? Our users are interested in the shares that are on your marketplace. Is there a way for us to get access to them? And at that point, Robinhood is not a trading marketplace. You understand that. It's just a broker-dealer, right? They are an app. You can go in and buy Apple stock. The way they buy the Apple stock is they go on the NASDAQ to purchase the shares for Apple. In our case, we're the marketplace, right? So they would have to integrate with us and do the plumbing. So I didn't say it's impossible. Of course it's possible, but why would they want to talk to us? We're like not even on the radar for those people. They are only interested in the 4,700 stocks that are out there. I think the millennials are going to wise up pretty quickly when they realize how the financial marketplace really works. There's plenty of articles out there that explain it, and it's not pretty. And so we think that for them, if they are interested in those great companies that we are able to bring onto our platform, maybe they'll come in and give us a visit.
First of all, I'd like to congratulate you for what you've built at StartEngine. You've really opened up a tremendous market for emerging young companies and entrepreneurs. And it's very hard today for small companies to do IPOs. That whole market is is only for a little larger sized company, so congratulations.
Thank you.
How big do you see the crowdfunding market, being, 3, 4, 5 years down the road?
Well, our ambition, as I demonstrated this morning, is to help 10,000 companies raise $10 billion in the next 10 years. In the next 5 years, I think we're at 350 companies. I think that Max, he actually publishes our StartEngine index for those who are interested every month, detailing the questions you have in terms of market and its size. Maybe you can comment on that.
Yeah, so it's on our blog, the StartEngine Index. I basically, along with one of our developers, we scrape all Form C filings once a month, and then pull all the data from the corresponding web pages. So we publish a report that shows the total raise amount across regulation crowdfunding once a month. We've been doing that since mid-2017, but the data goes all the way back since regulation crowdfunding started. Yeah, so you can check that out. We break it down by industry, locations. You can see which counties are raising the most, and that can sort of give you a sense of what it looks like today.
And so the StartEngine Index is another product we do. We don't talk too much about it, and but it's a resource for all of you, because then you can see what other people have done. I think within 5 years you'll see probably over a 10 times multiple. So I think it's been about 2,000 companies. I don't know, Max, if you remember how many companies.
I think the last month is 1,552, if I remember correctly.
So 1,500, so 10 exit, that's 15,000 companies that will have access to raising money from the crowd. It's very possible that we'll have some upgrades to the regulation. So regulation crowdfunding allows you to raise a little bit more than $1 million. That's possible too. There's a lot of things that can happen that are wonderful. By and large, my hope is this, that 5 years from now, you have talented entrepreneurs who are deciding to start a company. And instead of calling Sand Hill Road and all the venture capital companies first to see if their idea has any interest, they go first on StartEngine or other platforms like ours, and they raise the capital as proof of concept for the idea. And that is going to be a transformative phase for our marketplace. As you probably know, the venture capital industry is good for 0.001% of the population, but they get the lion's share of the capital. I've read recently that it's on over $100 billion being invested. So what about us? What if our marketplace can be tens of billions? Why not? Now with liquidity, I think that's possible.